All right, so a whole bunch of things conspiring to make this a really tough session so far. First, of course, you just heard talking about these healthcare stocks, Humana, CVS, United. By the way, this is the most influential stock on the Dow. One of the reasons I don't like using the Dow, because only 30 stocks is just a poor representation of the market and the economy. Nevertheless, it's one of the reasons it's down a lot. But it wasn't just, of course, the fact that this Medicare Advantage thing came up short. Last night, PVH, right, Philip Van Heusen, top products of Calvin Klein and Tommy Hilfiger, laid an egg when they reported their results. That stock's down 24%. Some of the names down and with it. Ralph Lauren is down along with it, and some other names. And then, of course, there's just higher gasoline prices, right? I mean, people are paying more at the pump. They're not going to be able to go on things like the Norwegian Cruise Line. And then, of course, last but not least, speaking of gasoline, Tesla, folks. Tesla came out this morning with their cars that they distributed. Just an absolute disaster. Even though we've been warned the number was going to be down, at the open, this is what it looked like. Might have changed a little bit, but for the most part, a real tough session so far. Now, speaking of gasoline prices moving higher, so are bond yields, right? And here's the thing. This morning, this gap here, you see this line, this resistance line? We gapped over that this morning. This is the key resistance line. This right now, if you look at this, there's not a lot of resistance all the way up until this huge gap at 4.7. That would be absolutely catastrophic, but it could happen. I mean, listen, there's a tremendous amount of speculation in the meantime in this market, and that's one of the things that could start to add to volatility. Hedge funds, for instance, they're net short equities, right? So you can see their long positions, their short positions, net. Hedge funds right now betting that something is going to happen and that we're going to hammer it real soon. And of course, you know, listen, if it goes the other way, then hedge funds will help in the short squeeze. But right now, hedge funds are betting big time that this market's going to come down. Speculation, though, not just reserved for hedge funds. These are asset managers. You can see speculative positions. Look at this, just through the roof. So is it any wonder? You start to think about this, right? And we have a lot of guests who come on and say, hey, it's stay in the market. Don't worry about it. Buy and hold. Well, we're not buying and holding anymore. We used to, not long ago, well, maybe long ago. The average holding period for a stock, people will buy a stock and hold it for 8 years. Right now, it's down to a few months. Who knows? Soon it could be down to a few weeks. So with that in mind, there is a notion out there that this market is due, folks. I mean, all these things that we're talking about is a toxic brew. Then you add to it how long and how strong we've been. Again, it's been over like 110 trading days without a 2% decline. Relative strength has been over 50 for 100 trading sessions. And ironically, you're not supposed to short this kind of thing, but at some point, it goes up and it peaks. So let's bring in Bianco Research President Jim Bianco. And Jim, you know, I know it's easy to say that the market is due for a pullback, but it seems to follow Newton's law, right? I mean, because it feels like you need something to counter a force in motion, and this force has been upward. So what can happen to make that change?
Oh, I think it's the basic, the cost of money. It's interest rates. If the cost of money was to go higher, and it is, as you pointed out, it broke out among its resistance, that is going to make everything in financial markets more expensive, and that will weigh on the market. Now, I know there's a narrative in the market that, oh, interest rates don't matter. And I like to joke there's only two types of people that think interest rates don't matter. Those that have lost money and those that will lose money thinking that interest rates don't matter. They do matter, just sometimes they'll assert themselves at different levels. So if interest rates start up, it will matter, and it will be a counterbalance on this market.
So we had some economic data out today, both sort of underscoring the resolve of this market. Factory orders were better than expected. The JOLTS number wasn't really a jolt at all. And this gives me a chance to bring up a chart you posted over the weekend showing the GDP. Since the lockdown, right, we had this big negative in the GDP. It has been extraordinarily powerful and still expected to grow pretty strong. You've got the Atlanta Fed GDP numbers up there. I know Goldman Sachs put out some numbers last night. So if this is the case, what does it mean for Fed policy? Because this does not look like a reason to start cutting rates.
That's exactly right. This is what I've referred to, and many others have referred to as the no landing scenario. The economy is not soft landing. It is continuing to grow, and that's good. Nobody wants the economy to not grow, but it can come with a consequence, and that consequence is all of this economic activity is pushing prices a little higher. That's inflation. Not like, 8 or 10% or 9% like we had a couple of years ago, but sticking in this 3% range. And that's going to keep interest rates up. So, yeah, it's great that the economy is growing and we all want it and I want it too, but it's also not going to happen with interest rates falling. So that's what's going to be the pushback on this.
Hey, before I let you go, you talked a few months ago about bond yields being 5.5%. Everyone kind of, you were certainly on an island by yourself. I mentioned at the start of the show, we gapped open today. Not a lot of resistance. Maybe we get to 4.8, close that gap, 4.8%. But I mean, is this still possible? Let's say we get there. More important question. We get there. 10-year yield, 5%. What happens to the stock market? What happens around, with the broader markets?
So the last time we were at 5% yields was late October. And so we've been there before. And that was also the last time that the stock market had a 10% correction from its July peak to its October low. And yeah, interest rates weighed on the market. So I suspect that if this breakout and interest rates are moving higher and 5% is not going to really impair the economy, it is going to bother the stock market because that is what has happened in the past. And I suspect that that's what we're going to see going forward.
All right. Hey, good stuff, Jim. Always appreciate starting the show with you. Thanks a lot.
Thank you.
Folks,